Hopefully people have understood something I've been saying about interest rates, which is that they reach a peak, and often the peak comes along sooner than people realise, and there are elements of discussion about that starting to appear at the moment. Well, hello again, everybody. This week I'm going to talk about interest rates because that's basically the thing which people have got themselves fairly worried about at the moment. The Reserve Bank, obviously, with that recent record increase in the official cash rate of 0.75%, and then warnings about interest rates rising to very high levels. I can see, as I mentioned last week from my survey of real estate agents, that buyers have definitely pulled back anew from the residential property market. But hopefully people have understood something I've been saying about interest rates, which is that they reach a peak, and often the peak comes along sooner than people realise, and there are elements of discussion about that starting to appear at the moment, and they're couched in terms of, I wonder if the Reserve Bank is overdoing this, having eased monetary policy too much in 2021 in particular. Maybe they're tightening too much at the moment. And a key motivating factor here is the monthly business outlook survey from ANZ, which was undertaken almost completely before the Reserve Bank's monetary policy change on November 23. And what the survey showed is business sentiment falling to a new, very low level. Businesses on average saying they're going to cut capital spending and lay off people. It's basically the sort of thing the Reserve Bank would want to see as a result of monetary policy tightening. And one wonders if they'd actually had that information in hand, if they might have increased only 0.5% rather than 0.75% of a couple of weeks ago. But we've also got in hand data of the number of consents issued for new dwellings to be issued, falling about 11% in October. So finally, residential construction by that measure looking like it's going to be easing off. Some of the inflation measures overseas improving, international oil and food prices pulling back, along with shipping charges. So you'll be starting to see this talk about, maybe the official cash rate does not in fact need to go to the 5.5%, which the Reserve Bank has basically penciled in for the first week of April. Well, what's happening, of course, in the wholesale markets is something quite interesting. Yeah, people are thinking that as a result of monetary policy tightening, the cost to banks of borrowing money to lend to you and I has gone through the roof. No, it has not. And here's an example. For instance, if the bank wants to lend to you at a fixed rate for 1 year, they borrow in the wholesale markets at a fixed rate for 1 year. Before the higher than expected inflation number in the middle of October, that 1 year cost of money to banks, we call it the swap rate, was 4.8%. The high inflation number came out in the second week of October. That cost of funds went to 5.3, settled at 5.2%. Banks in response increased their fixed mortgage rates about 0.5%. It's all logical, no worries. Then the next interesting thing is we get some lower than expected inflation numbers overseas. That 1 year swap rate falls to 5%. Banks don't cut their interest rates. And then we get the extra tightening of monetary policy from the Reserve Bank, the scary words. So where has that 1 year swap rate gone now? About 5.2%, where it was after the high inflation number. It's not changed. But banks have increased their interest rates again by 0.5%. If I were to run through those numbers for, say, 3 year fixed rate borrowing, lending, etc., actually the numbers are back to where they were before the high inflation numbers. All the interest rates you've seen, the increases from the banks, it's been all about rebuilding margins. And those margins are now basically back at their 2 year average levels. So I'm 90% confident that what you're seeing now for new borrowing out there, that these are the cyclical highs in the fixed mortgage rates. Like I say, 90% confident, always got to allow for something untoward coming along. Over the next few weeks, let's say 2 to 3 months, you're going to see a bit more discussion about interest rates peaking out. People will see the worst case scenario. And so I think there's going to be a little bit of strength returning in the residential real estate market. But maybe let me just finish off with a comment I've made before, and it's directed towards the first home buyers. This may be the best opportunity you have to secure a house which really is going to meet your needs, in a generation. The investors aren't there in the market. The vendors are more more willing to make a deal. The banks are slowly easing their lending criteria. Your income on average is up 8 or 9% from a year ago. Job security is strong. So keep these things in mind and just be aware at some stage the sentiment will turn in the market. That's probably the middle of next year. But like I say, the best opportunities maybe for buying to pick and choose will be available well before then. So all the best out there.